Good morning, guys. How are we doing? You know, that's barely better than I asked than I got a few minutes ago. Come on. You gotta have some responsiveness. So what I want to do today is kind of just talk back through, to the extent that you have some questions and want clarification, some of the different things that we've hit so far. Okay? Recognize that we're still simply looking at review from Finance 300 at this point, right? But we start to make the transition beyond that today. And we start to look at a couple of things that will help us next week. Now, obviously, we don't have class on Monday, so next week's a short week, okay? But we'll cover quite a bit of ground that day. So I want to deal with some questions. I want to then go back through that quick sheet, which I see I've given you a copy of. But I want to make sure that the relevant items that you're really going to need are you know where they're at there and they're articulated so you understand them. And then I want to give you a financial statement, a fictitious financial statement. And then we're going to work through some of these numerically, okay? Preparatory to you working on the problem set, the in-class problem set, which I will probably only introduce to you in class. And then that will be your homework that's due when we come to class next Wednesday. And when I say it's due, and I may have already said this, it means that as you come in by 10 o'clock, you just put it right in, okay? Sometimes these are delivered in hard copy back to me, okay? Sometimes I ask you to deliver them, upload them into Canvas. On this one, I'd like to see a hard copy, but if you also would like to, go ahead and upload into Canvas if you happen to have done it, typed it out. You'll notice that the problem sets, you have an MS Word document that's linked for each of the problem sets, specifically so you, if you want to, can type out the answers or work out the problems in Excel and then just copy and paste answers and such there. And that's because sometimes I'm going to require that you upload these to Canvas. Okay? And when you upload, you'll upload both the Word document that's completed and you'll upload the spreadsheet that you're using in support of it. Okay? All right, so with that, you'll notice I'm taping this today. I'm probably going to end up taping most, if not all, of our classes as we move throughout the term. And I will load those to Canvas for you. Okay? I'll link them on the week in which the class took place. So that might be a little bit helpful for some of you guys. All right, so what have we gone through so far, really? No, don't look at your note. Don't look at your note. Try to do it off the top of your head.
Production value that we focus a lot on.
Okay, so we've had general conversations about production value.
Yeah.
Bobby, right?
Yeah. Well, kind of specifically the summation of our future cash flows.
Yeah. The present value of the sum of all the firm's expected future cash flows. Okay, cool. Yeah. That's the production value of the firm because the firm produces what for us? Cash flows. Yeah. I don't care if it's tennis shoes or rocker arms or 747 airliners. It produces cash flow because we're investors. Okay. What else?
Look at the formula for your future cash flows.
We've looked at it a little bit, right? So the formula for future cash flows, we're going to look at that ad nauseum, Zach. In fact, you're gonna mumble at your sleep, and then you're gonna wake up thinking, "Oh my gosh, what has he done to me?" We're going to look at what will seem to be 8 or 9 variations on that formula, but in fact is simply one formula and one construct that you'll get real familiar with. Brigham?
We did some enterprise value. We kind of went over the formula and what it is.
Okay. Explain to me what enterprise value represents.
Well, I remember it's the preferred common someone else minus cash. What was the...
Okay, so that's kind of the equation,
Oh, the
but what's it
equation.
represent?
Oh, it's the value that isn't the value that you estimate when you're just going solely off of the stuff in the...
Yeah, so when we estimate production value, What we're actually estimating is a number that should inform us of the enterprise value. Now, sometimes we don't have to estimate enterprise value, right? Under what conditions do we not need to estimate enterprise value?
We know the market cap of preferred and common.
Well, it's a publicly traded firm, and so all those market values are there for us, right? So we can just calculate it rather than estimate it. And in which case, if we have calculated enterprise value, what is the virtue in estimating production value?
Can kind of give you a price point on how much you should pay for that.
Yeah, so let's say we're looking at, and you guys watched the demotoring video, right? So let's say we're looking at a company, and the market, through all of the economic exchanges of millions and millions of economic agents, right? The market has valued this asset with an enterprise value of $100 billion. And you're thinking, hey, that's way cool. It's a sexy company. It's got a Shazam, neat whiz-bang name. I'm going to go ahead and buy into this because it's certainly got legs. Let me run a production value estimation to see if it's over or undervalued, or if I really think it is what it is. And then you run the estimation. And you see that you estimate that the present value of this asset based upon its expected future cash flows is actually $120 billion. So its enterprise value based on the markets now is $100 billion. Its production value based upon your best estimates is $120 billion. What do? Do you like it? Do you hate it? Do you want it? Do you run away from it?
Buying
No, we like it.
I think you like it. Why do you like it, Garrett?
This value is gonna grow $20 billion.
Yeah, because you think it's worth more than the market's currently valuing it as. Okay? Now, that's not necessarily what valuation metrics are intended to do or designed to do. But that's how an investor might use them for something that they're looking at in the public market. Recognize that what we haven't done in that little metric is thought about a dollar value per share of the common stock. Now, we certainly use that for the enterprise value, but when we estimate production value, let's say it came up with 120 billion, that's not the market cap of the common, right? That's equivalent to what we think the market cap of the common, the market cap of the preferred, the market value of the debt minus cash should be. So we may have to think a little further in order to strip that back to think about what the market value per share of common maybe should be. We'll deal with that at some point. We're not going to do it today. What else have we talked about so far that's relevant? Lots and lots of little detail-y review things, right?
Tax on EBITDA, tax on taxable income, and tax on
Tax percentage based upon taxes paid.
yeah.
Okay. Why do I like, for the valuation estimator, why do I like to use the tax rate on EBIT? Zach?
because it's what in theory you should be taxed on before there's deductions or write-offs.
If you were to be taxed on that number.
Right.
Yeah. We all recognize that it's an unusual set of situations in which taxes are actually applied on at that number. But the important part is that it was before all these extra stuffs. And you said deductions. I'm gonna modify that just a little bit, because deductions might be deductions for wages that we paid, deductions for rent, which all has already been accounted for in EBIT, right? Let's say adjustments. Okay. And I knew what you meant. You're right in terms of what you meant. So we need to know some cash flow number that is void of any exogenous or discretionary inputs that have nothing to do with the endogenous system that is this firm or this asset we're buying, right? Or valuing. What's exogenous mean?
Outside of something.
Comes from outside of the system, yeah. And for us at this point, the company pretty much is the system, right, Bobby? Okay. So endogenous means it comes from inside, right? And the best example, or the most common example of an exogenous influence is going to be a government influence, right? So the government influences tax rates. It's got nothing to do with the actual governing of the business. The government issues or influences depreciation as well. But we use depreciation as one of the expenses getting to EBIT, don't we? Why do we do that? Because I just argued that we don't use a government-influenced element with taxes, but we do use the government-influenced element of depreciation. Why? Please, Cole.
Because the depreciation scale is going to be the same for everybody?
Not necessarily. Remember that we kind of have two different ways of accounting. Doesn't mean we keep two sets of books, by the way. That's felonious. We have two different ways of accounting. We have GAAP, Generally Accepted Accounting Principles. You guys have had Accounting 213 and 313, I think, or at least some of you have had 313. So Generally Accepted Accounting Principles, and those are sanctioned by FASB, the Financial Accounting Standards Board, and those are the rules that all businesses must comply with when they're thinking about how they account for the business to communicate its numbers to potential stakeholders of the public. But the rules that we utilize when we account for our taxes are a little bit different. Some of the GAAP rules morph when it comes to accounting for taxes, such as I might be able to use a straight line depreciation of 7 years on an asset when I'm trying to come up with some numbers to communicate to my board or potential shareholders or stakeholders. But I might want to use Modified Accelerated Cost Recovery System. In fact, maybe I have to use Modified Accelerated Cost Recovery System, MACRS, when it comes to accounting for my taxes. So the GAAP standards are more for communicating amongst business people and those that have a stake in this, and those are morphed a little bit for IRS accounting standards. So within GAAP standards, you could choose 5 years, 7 years, double declining balance, straight line, ACRS, MACRS, or Mickey Mouse, right? I always think Mickey Mouse when I say MACRS. I don't know why. Now I guess I do know why. Any of you ever seen the Mickey Mouse show? MICD. Apparently it's a different generation. A few of you did. Okay, so we've talked about that. What else? I keep pinging on it.
We kind of just went through an income statement and broke down each part and why each part is significant.
A little bit, yeah. We're going to do more of that today. We're going to give you one.
Future cash flows we went over.
We've talked about free cash flow,
I
haven't
mean
we?
free cash flow, sorry.
Yeah, and the different ways of looking at free cash flow. So let's pick up there. So somebody give me the equation that you'll almost always use. It's terrible. For free cash flow.
No plat, plus appreciation.
Well, you almost had it in unison too. Man, that was good. So no plat plus depreciation. And when we say depreciation, do we only mean depreciation? What else do we mean, Francesca? We probably mean amortization as well, probably. But many firms, in fact, I'd say most private firms have no amortization. What is amortization? Sherry? Just conceptually. And by the way, whenever I call on somebody like that, if you hesitate, which is fine, anybody else can step in. What's amortization?
It's for intangible assets.
Yeah, so it's a depletion of value of intangible assets, whereas depreciation is a depletion of value for tangible assets. Okay? So minus, what was next?
Change in net working capital. Change
Change in net working capital minus
NCS.
net capital spending. Okay. How do I get no plat? So EBIT times 1 minus the tax rate on EBIT if EBIT were to be applied to a tax schedule. Now here's one of the less accurate things we're going to do in this class. We're pretty much always going to think about taxes as being a federal element only. We're not going to think about state and municipal taxes. It's not that they don't exist. In fact, they exist in almost every state, right? It's just that I don't want to have to think about 50 different states worth of tax regs and calculations. So when we talk about taxes, we're almost always going to be applying a federal corporate tax rate. Recognize that we're leaving a little bit unaccounted for because there are state municipal taxes, aren't there? Zach?
So going forward, are we just gonna use the 21%, or are we going to, do it based on brackets?
Good question. So the tax calculator I've designed for you and placed online has a tab for pre-2018, which is the graduated tax rates based upon the income strata, corporate income strata. And then there's a separate tab for 2018 and beyond at 21% flat rate. So they're both there, but now to answer your question, it depends on the scenario we're looking at. So if we're looking at something and we're having to figure out no plat for like 2015, which sometimes we will, you're going to use the old rates. But if we're having to think expressly about tax rates for 2018 and beyond, we're going to use the new ones.
And so let's say that we were evaluating something for 10 years, so it started in 2015 and then went to 2025. We would do those first 5 years based on whatever tax rate they were at, or?
Oh, that's a good question. The way that I'm going to have you construct your models, your spreadsheet models, you ultimately adopt a tax rate on EBIT and a tax rate on taxable income, and use that then throughout the years. That may not be the most accurate way of doing it because of the tax change, but to try to adopt a separate tax rate potentially for the varying years could become more complex than I want you to have to digest and replicate. And as I said, I think in our first or second class together, I'm not altogether confident, in fact I'm relatively confident in the inverse, that the flat tax structure that we have right now for corporate income taxes is going to stay as it is. So I think what you're saying would be to be yet more accurate than our models are going to allow you. But once you've created the models, if you understand their creation, which you should as we're working on them together, you should be able to figure out how to morph that if you like. I just haven't taken the time to do that yet. Okay, and it's going to be rather complex to do, I think. Okay, so that's no plat. Change in net working capital is the net working capital from time 1 minus the net working capital from time 0. What's net working capital?
Current asset minus liability.
Yeah. Current assets from one period minus current liabilities from the same period. And so when I use 1 and 0, 1 and 1, or I could have just as easily done 2 and 1, or A and B, or now and before. These are just generalizations. It doesn't have to be specifically 1 and 0. Okay, it just means one period that came after another period, because 1 comes after 0, 2 comes after 1. Okay, I'm more often, when you see the notation I use, would use like 2015, 2014 to be yet more specific. Okay, what about net capital spending?
Fixed assets, sum 1, minus fixed assets, sum 0, plus depreciation from 1.
Okay, Sherry's right. Fixed assets from the current period, the current most recent accounted period, minus the fixed assets from the prior period, and that period differentiation probably is a year, right? Almost always. And then plus the depreciation that we accounted for during period 1. Are we double counting, or are we double accounting for depreciation? Are we messing ourselves up here? Why not, Ryan? So add it back in. So help me understand adding it back in the first two phrases of the equation. Yeah. So why, when we're putting it, when we're adding depreciation there, how is it adding it back in? What,
Because when we calculated no cloud EBIT, we had accounted for depreciation in the calculation of EBIT, so we
Okay.
had to add it back in.
so EBIT includes a deduction for depreciation. Okay. I say that because sometimes on different income statements, you see depreciation accounted for separately and sometimes after operating expense. And it is done so inaccurately, but sometimes you see it. You won't see it on my stuff.
And we want depreciation categorized like as an operating expense, but like,
Yeah, why do we want that, Garrett?
I don't know, I just know that you do.
Okay? Anybody know why we want to categorize it as an operating expense?
I think that might affect your tax that you pay to the government, right?
Well, yes, because it's a deduction from taxable income, essentially, right? That's not why, but you're right, it is that. Why do we want to, in the valuation discussion, why are we interested in including depreciation, a non-cash expenditure, in one of these inputs, and to get to EBIT? Because depreciation recognizes that the asset that we are making money from, the printing press, the plant, the equipment, whatever it happens to be, cost us something, right? And we don't have any other accounting ability to do that. Nowhere else have we been able to expense that asset. So if you think about it, depreciation is simply transferring money from the balance sheet to the income statement as an expense, right? Okay, so that talks about the first part. Why are we putting this thing in again, depreciation? Why is it there again for net capital spending?
Is that the same thing?
Well, it has a similar effect, but it's certainly not the same reason. Zach?
So for, when we're evaluating the value of our assets over that year, those assets technically go down in value. So when you're doing the difference between them, you want to add the depreciation back into account.
Okay, so where did we get this fixed assets from time zero number?
Book value at the end of year zero.
So it's on the balance sheet, right? Where did we get fixed assets from time one?
Book value, between one on the balance sheet.
On the balance sheet. Garrett, when you're a great accountant, right? I mean, you got a great CPA practice, you're killing it, man.
100%.
When you put a number on the balance sheet for fixed assets for your clients, has that number already been depreciated?
Yeah.
It has. So it was deducted between here and here, so we got to put it back in to recognize it. Because remember, we're trying to get to a cash flow, and that is a non-cash expenditure. Okay? So we've talked about a number of other things, but those are the relevant things I need you to kind of keep stuck in your head for a while. Okay? Let's take a look briefly at some of the elements in the corporate finance worksheet. I think you all have it. Does anybody not have it with them today? By the way, do any of you not have, I don't mean today, but in your possession and ownership, do any of you not have an HP 10B calculator? Cool. As we start to use our calculator here, starting next week, and I'll do a little bit of it today, that's the one you want to use. Okay? My guess is most of you got that in Business 101. Okay? That's the one we're going to use, just so you'll know. You might be more comfortable with some of the keystrokes of a TI or something like that, but I can't support those, and so I'm going to require that you use the HP. You're going to use it again in some of your other classes. Okay, so as we look here, third item down the list here is CFFA. What was CFFA?
Cash flow from assets.
Sure. And how many variants did we learn on CFFA in Finance 300? You guys are killing me. Either Lauren or Rich would be so disappointed right now. In fact, I'm almost embarrassed for you. 2, right? Because we can think of cash flow from assets in version 1, which is going to be the cash flow as they came from our assets, right? And then in version 2 is as we pay them out. So cash flow coming from the assets and cash flow that we pay out as a result of the assets. And what comes in really ought to equal what comes out, otherwise we don't balance and we got a problem. Okay? If you look at this, the equation for CFFA, I'll do 1, CFFA 1, so it's operating cash flows minus net capital spending minus change in net working capital, right? FCF, no plat, plus depreciation, minus net capital spending, minus change in net working capital. Are these the same numbers? Is CFFA 1 and free cash flow the same thing? And if so, under what condition are they the same thing?
No plat plus depreciation equals operation.
Yeah, because NCS equals NCS, I'm pretty confident of that. Change in net working capital equals change in net working capital, I'm equally as confident of that. That simply means that operating cash flow is equal to no plat plus depreciation. So let's see if we can reconcile that against what we already knew. So we're going to see here that it equaled no plat plus depreciation. But we see on your quick sheet that OCF is equal to EBIT plus depreciation, depreciation and amortization minus taxes. And I think the inference there, and you learned it in Finance 300, is taxes paid, right? You took that right off the income statement. So how are we equaling the same thing here? Can we say that depreciation equals depreciation?
Yep.
Sure. Can we generalize this or disaggregate it and say that no plat is equal to EBIT minus
taxes.
EBIT times some tax rate on EBIT?
Mhm.
Can we do that?
Yep.
So EBIT is equal to EBIT. So what we're suggesting then, when I'm saying that this is the same thing as this, is that we've used the same methodology to calculate our taxes. But we didn't in Finance 300, did we? Finance 300, we literally took the taxes as an expense from the income statement, right? Taxes paid. Whereas here, we've got some theoretical relationship we're trying to drive to make this cash flow variable pure and free from the influences of the decisions made either by governments, outside bodies, or discretionary decisions of the ownership of the firm that have nothing to do with the actual functioning of the necessary operations of the firm. So they are the same if the tax rates that we're applying are the same. And they're not if not. We won't use the term CFFA, but I know that that was drilled for you fairly heavily, or it should have been at least, at the beginning of your Finance 300 class, which was so a semester ago or so, right? But I want to make sure that you get that connection. Okay? Let's look at a couple of other things on here that we haven't talked about much. On the second page, in the middle of it. Do you remember SGR and IGR from Finance 300? Some do, some don't. Okay? So SGR is a sustainable growth rate. IGR is the internal growth rate. And they are only modestly different. SGR is ROE times B divided by 1 minus ROE times B. What's ROE?
Return on equity.
Yeah, return on equity. And how do I calculate it?
Net income divided by equity.
Net income divided by total equity. Okay? One of those comes off the income statement, right? One of those comes off the balance sheet. This is a performance metric. It's used predominantly to compare performances of an entity across multiple periods of time, or one entity compared to another. Frankly, to be honest with you, where I think it's used the most is by CEOs and other senior managers in corporations, well, because sometimes they get their bonuses based upon various performance metrics, and one of the most common of those is ROE. Improve ROE, you're going to get a X% bonus based upon the improvement or something like that. Okay?
What's B?
Oh, but we'll come to that. That's where we have to go next. And then we'll talk about order of operation. So B is equal to net income minus the dividend paid divided by net income. So what's another term for net income minus dividends paid?
Retained earnings.
Retained earnings. Good, Kara. So this is essentially our retained earnings as a percentage of our net income. Okay. Sometimes it's referred to as the retention rate. It's the inverse of the payout rate. Okay? So when we look at this, we're looking at some return on equity times some retention rate. So this was the return times the rate at which we retained it inside of the company, right? Divided by 1 minus this number, such that we end up with what's called a sustainable growth rate, or that number that we think, that growth number that we think the entity can sustain based upon its use of equity. Okay. So we're using our equity efficiently, we're not using our equity efficiently, what can we do with it? We should be able to calculate what kind of number we can perhaps sustain. Similarly, the IGR is ROA times B divided by 1 minus ROA times B. And ROA, of course, is return on assets, which is total assets divided by net income. It's total assets. So it's current assets plus long-term assets, right? Fixed assets.
Did you write it wrong though, net income?
I always do things upside down. It's my preferred posture. I'm sorry. Thank you. I'm just glad I had the right variables. So, what does that tell us different from ROE?
We're making based on our assets.
Based on how much we're investing?
Well, that's the difference between them probably, right? So what is total equity? It is the contribution of capital to the firm from the equity shareholders, common and preferred, plus retained earnings, right? That's total equity. So that's our investment, right, Garrett? Either the investment we initially made, we being shareholders, or the investment that the firm made for us as the net incomes were reinvested. That's what retained earnings do, right? We reinvest them in the company. Versus total assets will be all the assets of the company. Which of those numbers, assets or equity, is probably larger?
Equity?
No, assets.
Oh, assets.
I think assets. I think assets.
I thought you were going to ask like ROE or ROA.
Ah, you thought it meant which percentage equate. Yeah. So I think assets are probably larger because assets, total assets, equal total equity plus total debts and liabilities, right? So the only way for it not to be larger is if there are no liabilities or debt, which is a little unusual, isn't it? Doesn't mean it's impossible. It's just kind of unusual because that would include accounts payable It's a liability, not a debt. What's the difference for me in the way that we're going to talk about it between a liability and a debt?
So liability is general debt, long-term debt and short-term debt, and debt just long-term debt.
Yeah, exactly. So a liability is going to be any debt generalized, including current liabilities and long-term liabilities. Current liabilities aren't part of the capital structure of the company. We agreed that we don't extend credit terms to our customers in order for them to invest in our company. We extend those credit terms for our customers, which become their accounts payable and such, and we have just the opposite relationship, in order to facilitate transactions and make them more fluid and thereby having more of them. You reduce friction from transactions are more likely to take place, right? But that's not because our customers wanted to invest in us. Our customers just wanted to buy product or wanted us to buy product, right? We're the customer. But long-term debt is expressly where we have sought investment capital in our company by some outside entity. Would you ever loan your own company money and a long-term loan and put it on the balance sheet, or would you just contribute equity capital?
You can do both, can't you?
You can. So let's assume, Brigham, that you and I are partners in a business, 50-50. So we each put up $100,000 in equity capital. So we each own 50% of the business. By the way, love and trust you though I do, no way would I ever do that. Because when you go 50-50 partnership with somebody, what did you just guarantee is going to happen at some point?
An argument?
One of you is going to hire a lawyer. Okay? Because we're great friends, right, Brigham? We would get along. I'm really respectful of some of the work you've done. Nothing's ever going to go wrong between us, right?
Right.
Yeah. Your hesitation was well put. Your dishonesty in your answer, not so much. Okay? The chances of something going wrong are pretty good because over a lengthy period of time, you're going to disagree, and the unfortunate byproduct of the vast majority of partnerships is they end up in disagreements and one partner buys out the other, or they just whiz on each other in court or something like that. Okay? So I simply will not enter into equal partnerships. In fact, it's been years since I've been willing to even think about having minority partners. I just don't do it. Okay? Doesn't mean you can't. Sometimes at times you want to. But we're equal partners in this deal. Each put in $100,000. And the company needed more than $100,000. It needed $300,000. So we each put in 100, so it got 2. So there's another 100,000 that it needs, right? And I happen to have the extra $100,000. I'm going to loan it to the company. We don't want to not be equal partners. My loaning it to the company doesn't change our equal partnership, does it? We're still equal partners. And it assures me that I get mine back, that 100,000 loan, if everything goes to pieces. I get my loan back, I get my repaid on the loan, before we split partnership proceeds. And maybe even it assures my estate that I get that. So this can be an estate planning issue as well. And we get to decide what the interest rate is, right? Could be some honking interest rate. Could be a 35% interest rate. I'm not sure why you would agree to that, but I know why I would ask for it. Okay? So lots of reasons you might do that. Lots of reasons. I've literally seen people go equal partnership with $1 investment from each of them, and then one of them having a substantial loan to the company. And what they were doing, in fact, this is the kind of thing that, what's that guy's name on Shark Tank? Doesn't have any hair.
Kevin O'Leary?
Kevin O'Leary. This is the kind of thing that O'Leary would do. He wants to get his money back before the equity holders, right? So it's tantamount to creating a royalty sometimes, but you often see them extending terms to these companies, credit instead of equity participation, because they want to get their money back first before the equity partners or equity stakeholders get theirs back. So there's reasons you might do that. So now, sure, I asked which number would be bigger. You said assets. So net income, or you said equity, excuse me. So why would net income over total equity probably be greater than net income over total assets?
Smaller than
Because
that.
assets includes liabilities and equity.
Yes.
So it's a denominator stuff.
Yeah, so the bigger the denominator, assuming the numerator is the same number, the bigger the denominator, the smaller the value, right? Okay. So with that, let's look at, there's a lot of other material on here, of course, I'm not going to use yet. I've created a little financial statement we're going to look at together. We're going to run some numbers. So this is a fictitious company, and it's the Star Pine Group, and I will post an image of this in the video as I post the video online. Not that you'll need it, but for other people it might become important. And this is a very simplified balance sheet and income statement and a little bit of market information, right? So this is not an income statement or a balance sheet that you would find in a K-1 for a publicly held corporation. They're going to be far more complex. It's extremely simplified. But hopefully it gives us most of the numbers that we need. Okay? I think it'll give us all. So I just want to think about free cash flow. Let's start with that. So we need no plat. And depreciation, net working capital, and net capital spending. So let's do this for 2014. Where am I going to get my no plat?
EBIT,
Okay,
start off with.
so help me find EBIT. I don't know that I see the word EBIT on here any place.
Product sales minus cost of goods sold.
So here we have income, and there's product sales, services, private equity income, and that adds up to total income, right? In fact, I think our sales are what, 297, 196?
No, that's total. Sales
Yeah,
are,
That's total income.
Sales are 200.
Yep. I said it that way purposely, because sometimes you're going to see the term sales and revenue and total income used interchangeably. Now, I used the entire sales, or the entire revenue, rather than just product sales, right? How is it that I can think of services, so revenue that comes in from services, as being categorized under sales generally?
It's come with
Same
the
thing.
product.
Pardon me?
It's come with the product.
Not necessarily. It could sometimes, Sherry. Brigham, how's it the same
Well,
thing?
Services can still generate a revenue or something like that. So when it's coming product sales, a service could be something as simple as like an online software, or not even that, like just your like a phone call. So it could go-
Yes, service, I think, is principally a human capital related issue, right?
Yeah.
We get a service from some human or biological force or some equipment that biology created somewhere, right? So how is it that I'm saying that's sales? What am I selling, Zach?
Well, I think people use sales as a blanket term for revenue.
That's true, but I'm trying to get us to understand why, so that other things you might see, you recognize when they fit into that blanket term as well.
Bring in the cash flow.
Well, yeah, but Bobby,
I mean, you're basically selling your human capital.
yeah, we're selling our time, right? We're selling our human capital or our biological capital, because maybe it's human, maybe it's animal, right? You know, I use my horses for something. Okay, so we're selling time. So time is that product from the biologic capital, right? Okay? Private equity, this would be a return, investment returns, income returns from private equity. Okay, so apparently in this company, we made an investment in private equity. You can see that on the balance sheet. And so on the income statement, we've got some income coming in from it. Looks like 0.86. And this is all done in millions, so that's $860,000, so it's not nothing. So 0.86. How is it that our return from an investment in private equity is going to be categorized under what sometimes is generalized as sales? What are we selling?
I mean, you could have sold some of your investments or.
Well, we didn't sell the investment. This is income. This isn't capital gains. Pardon?
Dividends or gains.
Okay, so it's dividend. But how is that sales? We're not selling a dividend. Cole and the Garrett?
You're utilizing your capital for more.
Yeah, so just like with the human capital, we essentially have sold the use of some of our financial capital for a period of time, right? And we want to get the income from that. If I put rents here, so the rent like on an apartment building or whatever it happened to be, how would that generalize as sales? Think along the same lines.
Selling the use of a building.
Selling the use of our real estate, right? For a specified period of time at a rate. That's all. So think about all these things. You're going to see some things come into your purview over the coming weeks that won't be specified in terms of how it's categorized, and you're going to have to categorize it. And you're going to have to think generally and specifically to be able to do that. Okay, so we have sales at 297, 196. We have then expenses, and I'm going to say these are operating expenses. Because I think we would agree the cost of goods sold, sales and marketing, administration, and depreciation, which are the four expenses we see, we would agree those are operating expenses. There's no extraordinary expenses there, right? Or unusual expenses. And that's going to become 272, 556. When we subtract these expenses, operating expenses, from our gross revenues, we get EBIT, right? Sherry, you're just doing numbers, aren't you? I'm not used to you yet. Thought you were trying to invert them. What are you doing there? So what's the number? I think it's 24,640. Is that right? Okay, you guys have calculators. You should be able to come up with the numbers as fast as I can, walking to my desk and coming up with it with you watching. Okay? I'm expecting you to do some of that. I want you to get used to doing these things. Okay, so that's EBIT. Well, I'm going to do a 1 minus a tax rate to get it to no plat. I don't see a tax rate on here. Do you? No. And I'm not going to take the time at the moment to take that value for EBIT and plug it into my financial calculator. I think I've shown you how to do that. When I say financial calculator, I mean the spreadsheet that I've designed for you that can help you calculate taxes. It's online. You've seen it. So let's just assume that we've got a tax rate on EBIT at 21%. Okay? So in that case, what's our no plat? So we're going to take 24,640 and multiply it by 0.79, I think. Isn't that 1 minus 0.21?
Yeah.
And I think that's 19,456.6. 19,456.6. And by the way, you'll see sometimes when I do some of these numbers, calculating them for outcomes, I will actually go to the third or fourth decimal place. But we don't live in 3 or 4 decimal places on money, do we? I'll give you a second. Why do we do that, Alex? Why am I going to the third or fourth decimal place? Because I think money only goes down to pennies, right? To the second decimal place, right?
I think
It's 6.5.
yeah, you switch to 6
Did
and
I?
5.
Okay. Okay. Thank you. Is that what you're trying to tell me?
Yeah.
Thank you. So you guys are real friends. If I had a goober hanging out, you'd tell me about it, wouldn't you? Okay. So why do I go to 3 or 4 decimal places when I'm doing these instead of just 2? Because 2 encompasses all the pennies, right?
Sometimes it's
Just
millions
still-
or billions.
Oh, yeah. In this case, it's millions. So going to 2 decimal places only takes me down to the 100,000 level, or the 10,000 level, dollars. So I want to go a little further so I can keep some fidelity. Exactly. Okay, so 19,465 and 60.
What does keeping some fidelity mean?
Oh, good question. So if I have you calculate a number that ends up as 0.107389, and you convert that to a percentage, if you convert it to a percentage without any decimal places, whole percentage, that's going to be 11%, right?
Yeah.
Okay, because we're rounding the 7 up. Which, if we're talking about 11% of a dollar, it's no big deal, right? If we're talking about the difference between 11% of $1 billion versus 10.7389% of $1 billion, you can buy an apartment complex with that difference, right? In fact, a big one that'll give you rent for life, and you guys will be set up and some of your posterity. So when I start to get rid of decimal places and round, I lose fidelity, or I lose accuracy when I'm dealing with big numbers, okay? So one of the things you're going to find that I do, and one of the reasons I use spreadsheets to do everything in model form, is the spreadsheet, even though you might see it rounded a number to 2 decimal places in the cell you're looking at, in fact, it has retained all the information of that number behind the cell, right? And so if you interact that cell with another cell, instead of interacting 11% and 5, you might have interacted 10.7389% and 4.326, no, 4.626. And that's going to give you a whole different outcome, isn't it? Okay? And then if those are millions or sometimes billions, it gives you a really different outcome. So that's the bill. Good question. Okay, so we got EBIT. Let's go ahead and add depreciation to this. Where do I find it? Where is it? It's an expense. How much is it? 3.89. Okay, that was simple. Now let's do net capital spending. Fixed assets from time 1, fixed assets from time 0. What are my fixed assets in time 1? And when is time 1 when I'm looking at 2013 and 2014? 2014. It's the most recent, right? Okay. So what's my number for 2014 for fixed assets?
47.
It's right on the balance sheet. It's right there in black and white on the balance sheet. So 47, yep, 247. Minus, I think it's 44,890, right? Plus what?
Depreciation.
3.89. Somebody give me that number. $6.247. What does that number mean? What does net capital spending mean, Zach?
Well, that's how much we gained in assets, like, or how much we
Yes,
gained or lost.
yes. How did we gain it?
Acquired new assets.
So we spent that much money, $6,247,000. We spent that much money on new assets. Did it increase our assets book value by $6,247,000?
No.
It didn't because we had depreciation eating at the same time. Sometimes the change in net capital spending, or rather, sometimes net capital spending is zero. But Garrett, my CFO, runs into the office and says, Rick, it wasn't zero. We spent $7 million on new assets last year. How is our net capital spending zero? How would net capital spending be zero if we spent $7 million on new assets during the year?
Your depreciation.
Depreciation equals $7 million. Okay? So if we're only spending as much as the depreciation, all we're doing is replenishing our fixed asset base such that it is, so that we always have the same kind of value there. We're kind of replenishing it back to its original state, right?
Is that a model that companies use, or?
No. Oh, I shouldn't have said that so flippantly or so quickly. It could be. I just don't know why it would be. I guess if you're trying to simply stay at a steady state, you might target spending as much on new assets as your depreciation. But I don't know any businesses that purposely target a steady state, right? I think that we all have heard the adage, in business, if you're not growing, you're dying. Because somebody else is coming up to bite you, right? Zach?
Never mind.
Okay. Does that make sense? Most businesses that are trying to make something happen have a positive net capital spending. So why is it that we're subtracting net capital spending to get to our free cash flow? What's the inference here? We're spending more money on new assets than our depreciation, so we're growing our asset base, right? We grow our asset base because we think that we make money off of our assets. They're what we use to produce things in the firm, right? Why do we subtract that number to get to free cash flow? Zach and then Rick.
Well, when you think of free cash flow, that's before, like, that's the money that you use to make decisions, and what you spend on assets is something you should add to get back to that cash flow.
Okay, I agree with you.
Total amount of capital that you have.
Okay, anything else with that, Rick?
Just to add on to that, I feel like the reason you subtract is because that money's been spent, so it's not part of your free cash flow, because the cash flow is cash you're going to be able to use, and if it's already been spent on NCS, then that's out of the system.
But can't we argue that I could have chosen to spend it on something else instead, or maybe not spend it?
You could, but it, but
Yeah.
isn't,
I was gonna say that, like, when you're acquiring a business, you're already assuming that you're acquiring all the assets, and that, I kinda like lost my train of thought with it, but
It's okay.
Am I on the right track?
I don't know that you are or not, because I need to see where the train was going, but let me help you, or Zach?
Well, wouldn't it not matter if you spent it on something else, or if you just kept it? Because if you kept it, go to retained earnings, and that would be our change in net working capital.
Well, you're right, we're gonna see it reflected there as well, but I think it is still relevant as to why it's here. This EBIT, how do we get this?
By subtracting.
Yeah, okay, but I don't mean mathematically how do we get it. Functionally, how do we get this EBIT?
sales minus expense.
And where do we get the sales from?
Here's the income statement.
Yeah, how do we put the, what caused us to put?
Assets create products.
Assets create the things that we sell, right? Had we not recognized our spending on those assets that helped create this, we'd have a problem in the way of thinking, right? We wouldn't be using similar terms. If we're going to use a number that we believe has come from the assets in our business, our productive assets, then we've got to use the number that helped us get those assets.
So think of net capital spending like as an operating expense. Like money we spent.
Yeah, I know exactly what you mean. I'm hesitant to use the term operating expense because that has it has this GAAP connotation. Think of it as a necessary expense. Is that okay? Necessary expense. You're right in what you're thinking. I just don't want to say operating because of the GAAP connotation. That wouldn't fit within a GAAP law. Okay, but yeah, it's necessary. Had we not spent this, we wouldn't have had the assets that created this. The depletion of value we've recognized with this. Okay, so we're in the same sphere here. We haven't moved much at all. Okay, next one. Change in net working capital. So let's look at net working capital from time 1 and net working capital from time 0. Current assets minus current liabilities. What's the net working capital for 2014? I'm sorry, say that louder, please.
So just use the total current assets from 2014 minus the current liabilities.
From the same year. Yep, so what is the number? You have calculators, I have a pen.
66.912.
66.902.
912.
912,
Yep.
thank you. And net working capital from 2013?
58.44.
And so what is the change in net working capital?
Um, 8.472.
8.472.
2.
Thank
Sorry,
you.
I'll speak louder.
So net working capital from time 1 minus net working capital from time 0 gave us 8.472. So with that, wait for my eraser. With that, what is our free cash flow?
8.636 or 8.637.
Okay?
That's what I got.
So then, 19,465.6 plus 3.89 minus 6.247 minus 8.472.
So my question, that 19, would that be 19,000 or would that be 19 point? Because we got that number from,
Ah, thank you.
because I used
Yep, yep.
19.4.
Thank you. So 19.4656 minus, or plus 3.89 minus 6.247 minus 8.472. And that's our free cash flow. Okay. Is that the only way we know how to calculate free cash flow?
No, we can also use the growth rate.
We've got another number. I gotta put this here.
What exactly does free cash flow tell us again?
Okay, just a second, I'll answer that. 637. I'll turn her back around to you guys. What does free cash flow represent? Brian, what's free cash flow represent?
Isn't the decision-making of the firm is mathematically represented?
Okay, so it's a reflection of the decisions the firm made with respect to its cash flow. What else? Alex, what do you think?
I'm not sure.
Okay, Garrett?
Is it like a way to like strip down all businesses of like all the assets they've acquired, like all the capital they've acquired, like subtract their depreciation to the point where it's just EBIT?
Yeah, I see what you guys are trying to do. You're trying to make it a little too complex. Gregor?
And we've learned about it in 300, just cash is king. It means that's all the money you have, so it's pretty much liquid money
It's the money we have available
to do whatever we
to then make decisions with for the next period, right? This is what's left. After we made some decisions about our net capital spending, after we made some decisions about our current assets and current liabilities or our working capital, we actually did that, right? After the government helped us make some decisions with respect to depreciation, we have some government influence here in NOPLAT as well with taxes, right? This is what's left for the business managers, decision makers to work with in the future periods. They can give it to the stakeholders, they can keep it all in the business, they can do whatever they're empowered to do. Brian?
I was gonna ask, I think you might have just answered it, but like for example, there's still owner's equity. Is that what you're saying they can give it to the stakeholders and stuff if they want to pay dividends and stuff? Would
Yeah,
that
so
count for that, or
it
is that
helped
counted?
us get to our owner's equity, right? You can't just go out and spend owner's equity today because owner's equity might be already invested in plants and equipment and technology and all kinds of other stuff, right?
Yeah.
So this is what is spendable. Because as one of you said this, and it was you, Brigham, cash is king. Cash is king. Cash isn't everything, it's the only thing. And that's not universally true, but I think you get my point. When you don't have enough of it, it is the only thing you think about. When you have enough of it, you can make some other decisions. You can free up your mind. Okay? Well, as it turns out, this is an important number, so let's think if we can replicate this number by the other equation that we know. And I will do that over here on the other board. Let me put the the change in networking capital number down. What's the other way that we know that we can calculate free cash flow?
No plot, and then parentheses 1 minus growth over ROIC, I believe.
Okay, so no plat times 1 minus growth divided by ROIC, G divided by ROIC. Under what limiting conditions will you use that equation to calculate free cash flow?
Only if you grow the budget.
Okay, that's one of them because it's kind of hard to do without it, right? What else?
Or you're trying to figure out the growth rate.
Maybe, which we're about to do. What else?
Key value driver.
Yeah, so when you're asked to use the key value driver evaluation model, okay, and in that model, which you guys don't know yet, but you will very well, you only use it in the continuation term or the terminal value. I don't expect you to really connect to that term all that well yet, but by the time we're done next week, you'll have a much better internalization of that phrase.
While doing modeling and stuff, do you find that we'll be using this more common or the one we just did? Probably the one we just did, huh?
In fact, you will always use the extended version of free cash flow that I have in blue.
You're saying only
When
if the
you-
terminal-
Hang on. You'll always use it when you're calculating the cash flows for given periods. But when you have to create a terminal value in which you generalize for future cash flows generally, you'll use that one
Okay.
in red. And only then will you do that generalization for the key value driver equation.
Okay, thank you.
Okay? All right, so let's try to come up with this given what you have in this balance sheet income statement. Okay? I'm reasonably confident that no plat is still no plat at 19.4656. Okay? And I'm just as confident that 1 is a number that's pretty well understood by us. We don't have to calculate that one. Let's do ROIC.
Return on investment capital.
Return on invested capital. Good, Sherry. So what's the equation for ROIC?
No plat divided by invested capital?
Yep, exactly. So again, I know no plat, 19.456. How do I get invested capital?
Total debt plus total equity?
Okay, and that's come right off of your quick sheet or your notes, right? What's the other version? By the way, what's that version called? Total debt plus total equity is called what?
Financing approach.
The financing approach, okay? There's another way of doing it. What's that other way?
Operations approach, fixed assets plus net working capital.
Fixed assets plus net working capital, both from the same period. And this is the ops approach. So why do I like the ops approach versus the financing approach? If we're valuing the entire company, should they be the same number?
Yes.
Yes. In fact, if you look at them carefully and think about those components and their positions on the balance sheet, it should become obvious to you why they would be the same number. If we're looking at the entire company as an asset, do we always necessarily only want to think about the value of the entire company? We might want to parse it out, right, Garrett?
Yeah.
Yeah. In which case, I don't know how to parse out the equity the company raised 37 years ago. I just don't know how to do it. The company was in the back room of your garage 37 years ago. Now it's a multinational behemoth. I don't know what part of that money we raised 37 years ago is in the French operations versus those in Uganda versus those in Texas. But I probably can parse out the fixed assets because they physically reside someplace. And I can allocate out, based upon revenues and expenses, probably the contributions to net working capital. I can probably do that. Okay. So in this case, we're just going to look at the whole company. So we're going to say that invested capital is what?
Total equity plus total long-term debt.
No. I don't want you to do it that way.
You just said you wanted to look
I know
at
you
it.
could. You could do it that way, and you're going to get the right number. I want you to get used to using the operations approach.
So,
Didn't you say total equity plus net working capital?
Yeah, but I thought you said you wanted to look at the value of the whole company.
I do, but it's going to be the same number either way.
Okay.
So I want you to get used to using the ops approach. Fixed assets plus net working capital. Because you'll almost never go wrong. If they're the same number either way and you're valuing the whole company, it doesn't matter, right? If they differ when you parse the company out, then you should be using the ops approach, which means we should always use the ops approach.
I don't
Bring
want
them in
to.
and share.
I don't want to complicate things too much, but
No, you?
but why would you use the financing approach? Like, does it help things look better in the valuation, or?
No, because they're going to be the same number, right?
Okay.
So it can't help it look better.
Yeah.
Sometimes we know total debt and total equity, and we can find the market value of those,
Well,
whereas it's harder to find the market value of each individual fixed asset. So we have a 1978 Ford F-250 on one of our production lots that runs boxes around from one place to another. That's one of our fixed assets, right? What's the value of that? Thank you. I mean, I have no idea. At 1978, probably about $600, and that's assuming it's still running, right? But you get my point. It can be very challenging to get a market value for each and every one of our fixed assets. Sometimes if we are looking at the whole company and as a publicly held company, we know the market value of the debt, we know the market value of the equity, we know the market value of invested capital. So we might sometimes use that.
okay. Thank you.
Good question, by the way. Okay, so invested capital, fixed assets,
4%.
net working capital, so what's the number? Don't keep on a calculator. What's the number? Remember. You guys.
No, we got it.
47,247 plus 93,483 minus 26,571. Thumbs, fingers ablazing. By the way, in economics, what do we call the problem that we're observing? The collective action problem. Because every one of you thinks the other should be doing it. Okay. Got a number yet?
Are you going on the? Never mind.
47,247
Yeah.
plus 93,043.
114.1590.
11.4 what?
Whoa, 114.159.
159.
Well, it's decimal after the fourth.
Oh, is it after the
Yeah,
fourth?
sorry.
Thank you.
It's just-
Oh, that's that? All right. Yes, it is. I apologize. Okay, so then what is our return on invested capital? What is 19.4656 divided by 114 0.159. $19.4656 divided by 114.159.
0.1705.
Point what?
0.1705.
0.1705 or 17.05%. Is that a good return on our invested capital?
Depends.
How? On what? You're right, by the way.
So you have to compare to other similar firms and then the whole industry and see how you're doing based on this number and others' numbers.
Pretty much always when we're deciding whether a percentage is good or bad, it's in comparison, it's relative, right? Excuse me. And I would expand that just a little bit, Sherry, and say that it would be comparative to other firms in our industry. And maybe I would even say other firms of somewhat similar size in our industry, right? I would think a multinational behemoth would have a different ROIC than something you operate out of the back of your Volkswagen. Okay, I'm guessing, I'm hoping. Or it could be in comparison to ROIC for our same company at different points in time. Are we improving? Are we declining? Okay? So, cool. I now know a little bit more about this equation. 0.1705. What's G?
Growth rate?
Okay, so it's the growth rate of the income variable in the equation. And the income variable in this equation is no plat. So we have a couple of different choices here. We can calculate the growth rate in no plat from 2013 to 2014, which I'm going to ask you to do. Or we can take a broader look at this and calculate the growth rate of no plat over a longer period of time if we had more information, which we don't. Or we can think about if this is going to be used in a terminal value or a continuing value. We can think about what we believe the growth rate is going to be, what our projected growth rate, our anticipated, our target growth rate is going to be. Okay? We can compare the number to a couple of other numbers as well. Did we already talk about how you calculate two other growth rates? And if we did, what were they? Within the last 20 minutes.
Sustainable
SPR.
growth rate and internal growth rate?
Right. So those are possible growth rates, right? Sustainable is that which we think the equity can sustain over long periods of time. And the internal growth rate is that which we believe should be able to come from our assets. Okay? And they may not be the same number. Because one might be a pinnacle number and one might be a sustainable number. Okay? Please.
This way, on the sustainable growth rate, does it stay constant usually the whole time? Or because I remember in that video, I don't know if that, maybe I'm mixing up things, but then he talked about Tesla as having like the same growth rate for.
You saying it would
Was that
like
you?
Tesla would become the economy?
Yeah. Do you know in the?
Yeah, I don't remember.
It was in the video. He pretty
The
much.
Demoter video?
Yeah.
Yeah.
He said that Tesla had the same growth rate, so pretty much they'd become the economy at the end of the day because they'd continue to grow.
Yeah, so so I think to answer your question, is it constant over time? No.
Okay.
No. In fact, we project it as a constant, right? But if we were then to project the next 10 years, and 10 years from now, look back, we would have seen non-constant growth from year to year, right?
Yeah.
In fact, maybe we would have seen growth at a rate that was completely different than our projection because we were just wrong,
Okay.
which is very often the case. Okay. So it wouldn't be constant. What Demoter was talking about is the observable growth rate in Tesla's gross revenues is so high that if they continued that for, I think it was like 10 or 20 years, it's exponential growth. So Tesla would be the entirety of the economy because of the exponentiality of its growth, which is not reasonable. And that was his way of saying that's not a realistic growth rate, which is part of why I don't think he was all that excited about Tesla, right?
Yeah.
And I'm not all that excited about owning it. Like, I am kind of excited about owning one of them. Please.
Back to the Demoter video, you made a point that when doing the valuation, you want to use as few years possible. So if we were estimating G's, would we want to go several years back to estimate, or we want to go only?
That's a great question, Ryan. So Demoter wants us to use as few years as possible in our financial projections to come up with our valuation of Y.
Because I think it was on his blog actually, he was saying that the more complicated you make it, the more, I don't know, like, this is obviously my lingo, but he's
Yeah,
saying
sure.
you can get exposed. The more complicated it gets, the more messy it gets. So if you can keep it more simple, it's more predictable.
So I am standing on a limb and I am directly adjacent to the trunk of the tree. It's right at my back. And I'm pretty comfortable on this limb. Am I more or less comfortable now? Less, a little bit bouncy. Am I more or less comfortable now? I'm about to end up in your swimming pool, right? I go one more step out, and let's face it, I come in at around 200 pounds at this point, and that limb's going to break and we're done. Okay? So the farther we go out in time, or the more periods that we're adjudicating, the less likely our expectations are to hold water, to be accurate. So use as few periods as possible to make it as accurate as possible. Here's a problem with that. You're going to see this when we start dealing with continuation terms. We have to, at a point in these continuation terms, generalize a growth number, and that's going to be the growth number that we expect it to average in perpetuity. Not 1, 2, or 3 steps out on that limb, but an infinite number of steps out on that limb. Okay? So when we make that projection of that growth rate, are we likely going to project a 20% or an 18 or 37% growth rate? Like Tesla might evidence? No, because A, let's face it, any one of those are honking growth rates. We've never observed companies over extended periods of time evidence that kind of growth rate. Never. Challenge you to find me even one. Okay? Oh, for a few years? Yeah. Maybe even a decade. But that would be one of the current 4 horsemen. Google, Facebook, etc. Right? Microsoft, Uber, Apple, excuse me. Have you read that book?
Yeah.
Good for you. I just finished it.
Yeah.
Okay. So we've never seen it, so maybe we don't have any good precedents. We know that if it's very big, kind of like the motor said, after a very short period of time, it takes over the entire economy. Okay. But we also know as economists a couple of other things. Garrett, if your business is experiencing extraordinary growth in a competitive free market, and that extraordinary growth is equating to extraordinary profits, what's going to happen?
I'm going to dominate the market and become a monopoly.
Well, that's one possibility. All the rest of you are investors with access to capital, right? If you're seeing Garrett experience this, what's going to happen? What are you going to do? Right?
Enter the market.
Yeah. I mean, you're smart, man. You're creative and all that kind of stuff. But if you can do it, he can do it. At least he thinks so. I promise you, Cole can do it. Zach and Bobby are going to partner up, put their money together and do it. They're going to compete against you. What's going to happen to your market growth? It's going to shrink because they're going to be taking some of the market. Your profits are going to shrink. So if, in fact, you do have some period of that, the rest of that free market is going to nip at your heels, and it's going to slow it down at least. Until we get to what we think of as the zero profit condition within economics, right? You guys have had economics, right? 253, 263. I know you've heard these words before. Some of you heard them from me. Again. All right. So sometimes for that G, we're going to suppose a relatively nominal value. We're not going to calculate it rigorously. We're going to think of it as maybe being the expected long-run growth rate of the economy. Because why should this one company have a long-run growth rate that's different than the economy as a whole? What do we know about it in perpetuity that should differentiate it from the rest of the economy? So maybe that's inflation. Maybe that's expected changes in GDP. I would tell you that even if you use a 5% growth rate in perpetuity, you're being modestly aggressive. We've never seen sustained 5% economic growth decade after decade after decade after decade. But here's the other side of this problem. Zach, you're the CFO of this company right now. You're strong, you're capable, and you've given us great results, and we're extraordinarily grateful for it, as is observable by your bank account and your stock options. Okay, right? Your time is coming to an end. You're getting ready to retire. You've got your gazillion, still young, you're going to live out your life and play. You are going to help us, the board of directors, find another president that will take the next 10 years probably of leadership. You've been committed to growth. As a board of directors, are we going to look for another president that's as committed to growth as Zach is? If he's become wealthy, what happened to us first? We got wealthy too, okay? Are we likely going to try to do that? Or are we going to satisfy ourselves with somebody that doesn't grow our resources? No way. You, by the way, get paid well over 7 figures. You're well over $1 million a year. And the next guy coming in, or the next woman coming in, in fact, it's Kira as it turns out, she's fierce. Are you going to promise us a long-term growth less than the predecessor gave us? No way. It's just that little guy, wax his shoulders. Because, by the way, she's extraordinarily competitive. Okay? She's sitting here, and it's all she can do to not just have this great big grin on her face because she knows I'm right. There it is. Okay, I knew it was going to come at some point. Okay, so, Kira, you were hired. You now have committed to this regimen of growth for the next decade or whatever your period of leadership is going to be. And if you don't obtain that in a reasonable period, what's going to be your fate? Yeah, somebody else is going to fill your seat. But you do. You obtain it. And now 10 years has come and gone, and now we as board of directors are looking for another one. Are we going to choose somebody that's got some lesser growth expectations? This is going to continue on and on and on and on. So while I might argue for a nominal, modest, vanilla pudding-ish growth rate to be applied in the perpetuity equation, I can simultaneously argue why it should never be the case. Because as a CEO of this multinational conglomerate, you're always going to be on your game. You're going to be one of the best, to be very trite about it, right? So we can surmise why it should always be strong. At some point, Mason's going to be in that chair, and Mason's going to give us double-digit growth as well. And we're never going to choose anybody we don't think will do it. So we have this kind of dichotomy, right? Nominality is what we observe over the long term. Ambition and great numbers are what we expect because of how we put this together. And there's some friction between this. And the friction is wrought by reality, right? So, we got to put a number right there. Let's put 5%. And now, back row, the three of you, calculate free cash flow with this rate equation. Please.
So during this class, you're going to say that we find most of the time with the growth, it's going to be a given, or it's going to be based off an economic number. Is that what you're kind of coming at for this class at least?
It's going to be given sometimes.
Okay.
It's something you're going to have to come up with sometimes and justify
Based off
upon
assumptions.
other information,
Okay.
right? And you're going to find that as we are about to use in a moment, it may also be calculable.
Okay. And then also while they're doing that, I got a little bit lost on the IC. How did you get on the investment capital, I didn't get the first number that you're subtracting by. Was it just net working capital?
Oh, yeah, so when I give you those three numbers.
I got lost on the net working capital part. So
Okay.
I got the fixed assets part, but what were those three numbers
So
from?
the fixed assets were 47.247.
Okay, and that's, can I see that one? And then what
Yeah,
about that?
and then the current assets were 94.483.
So that's a 93.48.
Yeah, 93.483,
Okay,
excuse
okay.
me.
No, you're good.
And then the current liabilities were 26.571.
Okay, thank you, that one.
So I took fixed assets and subtracted them by, or added to
I
them.
just wanted to clarify that.
Okay. 3 brains, Excel, and a calculator. Do we have a number yet? Not quite. Garrett?
Why are we not just setting the equation equal to G?
Well, we're going to in a moment. We're going to reveal some differences. Okay. Yeah, good question. Zach?
13.757.
13.757? Got the same number, Mason?
Yes, but I also have a fourth digit for the.
That's okay. We'll leave it at this one, but you're right. You guys come up with something similar? Cool. Okay, so in that case, if we calculated this at 13.757, and if we were to rearrange this whole equation using 13.757 as free cash flow and calculating for G, we would get 5%, right? Because this is tautological. It's built into it. What if we do it differently? Let me find my eraser. What if instead, I'll bring this up. What if instead we say that we've got 8.3637? Because we didn't make any guesses to get to that number, did we? We had to make a guess to get this one at 13.757. We guessed at G. We didn't have to make any guesses to get to this 8.637. So if we have 8.637 being equal to 19.4656 times 1 minus G divided by 0.1705, can we rewrite the equation and solve for G?
Yeah.
Sure we can. And so let's do that for a moment. So we're going to divide both sides by 19.4656. We're going to subtract 1 from each side. Okay? We're going to go ahead and change the sign because we need to end up with this. Well, I guess we don't have to change the sign. We can now multiply both sides by negative 0.1705. And that should leave us at G. Okay, the front row, you're calculating this time. Somebody else come up with it faster maybe, but you guys are responsible. Apparently Sherry is the front row. We have a number. .09485. Okay. I think I got a different number. That's right.
I got 0.09491.
That's what I got too.
Okay. So
But maybe that's because we're doing different decimals.
divided by 19.4656 equal to times 0.1705 equal to change the sign. Minus 1 is equal to. Okay, so 9.48, we'll just call it 9.48%. Versus 5%. Which one's right? And what does the 9.48% represent? Read it.
It's the actual growth rate.
The actual.
For what period of time? For perpetuity?
2013 through 2014.
Yeah, because we used inputs, no plat from 2014, ROIC from 2014. So really, that's the growth rate between 2013 and 2014 that got us to that no plat and ROIC. So we can reverse engineer it. Sometimes we're going to have to because it's the best thing we can do. But when we reverse engineer something, never lose sight of what it's actually telling you. We used a perpetuity construction to do it, but I'm not sure that it necessarily gave us an accurate perpetuity value, right? Because we used inputs from a non-perpetuity relationship. So there's another way of doing it. There's another G that you're going to find here on your sheet. I believe it is, let's see, it's called an investment rate.
Hey Rick, really quick.
Yeah.
When I'm dividing both sides by 0.1705, would it make just as much sense to put the right side in parentheses, like with the 1 included, like start parentheses before 8.63 and end it after?
Ah, yes, I didn't do that.
Okay.
Thank you. In fact, I should have done that's necessary. It's not, it doesn't only make sense, it's necessary.
Okay.
I changed some behind it.
Yeah, that's why, remember, notice how I calculated it once and then I calculated it again? Because I hadn't done that the first time, I didn't use the right order of operation. Okay. Okay, thank you. So, there's another way, if you look at the second page of your corporate finance quick sheet, the last set of relationships, G equals a number of things. One of the things that G equals in that is my investment rate times ROIC. So what's investment rate equal? Investment rate is going to equal then
Net investment divided by no plat.
what's net investment?
Change in IC.
Okay. So we're not going to go through those numbers because we're almost out of time, but that's another way of calculating it, and it gives us yet another value. Okay, and it gives us a different number, which probably is going to be closer to the 9.48 because we're using inputs from the same period of time that gave us the 9.48. Okay? Zach?
Now, when we do these problems, are you going to specify which one you want us to use, or is it going to be to our discretion?
It will rarely be completely to your discretion. I will give you information that will have helped you know which one to use, or you will have been responsible to come up with a number and justify it. And if you've got that latitude and you say, well, I'm going to use investment rate times ROIC, I'm going to say, great. Defend how that is a perpetuity related value, because G, when we're dealing with it here, is almost always going to be a perpetuity G. And if you give me inputs from a particular period and tell me that that is going to be relevant to forever, I might challenge that a little bit, because I do recognize that business knows no steady state other than the zero profit condition from competitive markets. Okay, so hopefully this helped you a little bit with some of this, okay? And think about where we get the numbers and such. Let's look at a problem set briefly, and then we're done. Which problem set is due when?
Next Wednesday.
And how will I see this?
Corner of your
Turning in a
desk.
physical copy.
Yep. Now you're welcome to also turn it online, but I want a physical copy. Okay?
And with this, answers a lot.
Yep. The answers are online. So we're not going to really spend much time on this because we just did almost everything you're about to do. In fact, you're responsible by Wednesday to do questions A through G, and we did virtually everything A through G, but a different set of numbers, a different set of financial statements. Okay? Garrett?
When we turn it in, do you want us trying to somehow salvage the paper, or are we turning in the problems that we haven't done?
You're going to turn it in, and I'm going to give it right back to you.
Okay.
Good question. So I'm going to note that you turned it in, and I'm going to give it right back to you because for the next week, you're going to do questions H through M of the same problem set. Good question. Thank you.
Is this sheet online?
It is.
The Excel sheet?
Both the MS Word doc that's the problem set and the solutions.
Are these the solutions or?
Nope,
I mean-
these are the numbers that you're gonna utilize.
Is this spreadsheet online or is it all in Microsoft?
I believe, this National Media I believe NMM is online. I believe it is. But, one of the next assignments coming is you having to put together a spreadsheet that is the income statement, balance sheet, etc., and the financial relationships that come from the corporate finance worksheet. Okay? Because everything on the corporate finance worksheet, we can calculate from this set of information. Okay? And maybe a little bit more, maybe a little bit. So that's going to be one of your next assignments. So even though it's out there, I'm going to beg you to create your own. A, because it's an assignment, and B, because I know if you don't, you won't necessarily understand the mathematics of some of the relationships. And when you're going on to the models for the valuations, you're not going to know what tool you're using, and so you're not going to use it properly.
You're going to create our own.
Oh, excuse me, terrible.
You're going to say create our own balance sheet over the weekend?
I think that it would be worth your investment of time to recreate this
We're using the same one.
using this exact same format, the exact same numbers, but do it as a model. So if some of the inputs change, all the outputs change. Because you're going to end up with an assignment, I think, the week following to do just that.
Would you recommend putting the income statement and balance sheet on different sheets? On
No, I would not.
Okay.
I would not.
Same sheet.
Only because this is a simplified one, Garrett, and it's easy to see together, and sometimes you're going to want to look at the whole thing at one time. Okay. If it was a very complex one, sure, but this one's not. Okay. In fact, if you want to look ahead at this, the first Excel assignment is what you're actually talking about. Okay. So you can look ahead at the first Excel assignment, and you might choose to start to work on that as you're doing this work, because it's relevant. Okay? Okay, on this, notice at the bottom of this first page, it says G equals 5%. And I'm giving that to you. Okay? So I expect your answers in which you use G to have been reflective of 5%, not one of the other forms of G. Okay? That's going to make it a little more uniform, a little easier. All right? Any questions? Okay. Then I think we're clear. I'm going to miss you on Monday. I'm over it now. Okay, you guys have a great weekend.